following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes. It's time for Volatility Views, the premier radio program for volatility traders. Each week, we'll dive into the world of volatility, how to manage it, profitable strategies, and how to avoid the pitfalls of trading volatility. If it involves volatility, you'll find it on Volatility Views. And now, the Volatility Exchange is proud to present your hosts, Mark Longo and Don Schlesinger.
All right, and welcome to Volatility Views, live here from the Futures Industry Association Expo in sunny and warm Chicago here on the Hilton on South Michigan Avenue, indeed the mecca for all things finance. Wouldn't you say, Don?
I'd say that just saying sunny and warm Chicago has a funny ring to it. But.
Exactly. Of course, listeners, my name is Mark Longo from the OptionsInsider.com as well as the old Options Insider Radio Network, and I'm very pleased to be sitting here live next to my boon companion, good old Don Schlesinger from the Volatility Exchange. A little bit different, I think, than the last time you and I sat down live to do this when we were in the near the croquet courts in Boca, but still not a bad little venue to be doing this today.
Well, it's nice to get out of the home environment and rub elbows with not only some of our listeners, but so many people from the industry. And obviously, this is a premier show with about 5,000 attendees. We had dozens, if not hundreds of people stop by the booth and opportunity to speak to them about the Volatility Exchange and in general talk about our favorite topics. So it's fun to be out here.
And have you had Charlie, a man in the booth, most of the time?
We've had Charlie there.
Yeah, I imagine you've had a large female populace swinging by.
Our President Louis Burke and CEO Bob Krause,
Charlie's
Wendy
really
Robinson. So
you haven't lived till you see Don doing booth babe duty. That's that draws a crowd. The miniskirt a little bit much, I think, but the rest of it.
Charlie draws the biggest crowd. He knows everybody in Chicago.
Well, listeners, of course, this is a very big vendor show, and we are situated in the vendor hall here with just every exhibitor you could possibly imagine from across the world in the world of derivatives here, so it's a fun place to be doing the show from. We are also joined, that voice there at the end of the panel was our good old pit reporter, volatility pit reporter, I should say, good old Mark Sebastian from OptionPit.com. Mr. Sebastian, long time no see, sir.
I know. I feel like it's almost been 4 minutes.
Like we almost did. And we have some late additions from the last panel showing up.
He brought his fan club with him. This is going to be a tough hour.
And Mark, I usually love doing this podcast, but then I have to do it live, and I hate being the worst looking guy on the table, and it's terrible.
It's a hard. It's a hard cross to bear.
Thankfully, you insist on that goatee.
Yeah, and of course, we also have, last but not least, since Chris is new, we won't drag him into the mire that is our banter here on the show, but we are joined by Chris Strong. He is the Director of Research over at the Liberty Funds Group. Chris, welcome to the show, and what have you gotten yourself into, sir?
I don't know. They let me out of the office, though, for a day.
It's a Crossfire mixed with a few other elements thrown in here at the old Volatility Views. All right, now, with the panel complete, we're going to dive right into our Volatility Review.
It's time for the Volatility Review.
All right, and welcome to the Volatility Review. This is, of course, the portion of the show where we break down the action and the interesting activity we've been seeing in the world of volatility. And since you're on the end of the table there, Mr. Sebastian, and nursing, what is that, your 10th beer of the show so far? We'll start with you. What were you watching over the past, it's been a little over a week since we did the last one, but the past week and a day or so terms of
I was disappointed I missed last Friday's podcast. Oh, no, I was disappointed we didn't do it all live together because I would have been able to take close out Don's trade with me at 42 and been okay. But
what's it now?
It's since then.
I haven't seen VIX. Where is it?
But what's interesting is that
you could actually
I didn't know that.
You could actually see how little the option markets were impressed by the sell-off through 1100, because VIX volatility, nothing. VIX not spiking. It was. I mean, I was literally looking at this thing going, okay, we're going to blow through 1100 and absolutely no one cares. And we're going to run right back. And now we're actually at that opposite end. You know, we've caught all the way back up to 1200. The VIX is about where it should be for here. So what I'm going to be looking for is, are we going to get a push up to, in the S&Ps, are we going to get a push up to 1210, 1210,
10th beer, ladies and gentlemen.
1210, 1215. And is the VIX finally going to be able to break that 30 mark? And is it going to do it in, you know, is vol going to outpace the rally? And if not, you know what? We're going right back to where we came from, right back to 11 and a quarter.
I was actually a little surprised at something yesterday. Everybody knows what happened yesterday, and we had 3.5% movement in the markets. And so we know that there's this asymmetry with how much VIX moves percentage-wise with respect to the index movement, so that when you get downward movement, you may get a 5-to-1, even more relationship between the percentage move of VIX as opposed to the index, and then less so to the upside. But when I was out yesterday, you know, not looking at the market all day, someone said Dow moved 300 some odd points, 39 handles in S&P. I was trying to calculate the percentage move, which was about 3.5%. And I thought to myself, well, 4-to-1 to the upside. That's maybe a 14% movement in VIX. It's going to move like about 5 points and drop to 31. It didn't do that at all.
No,
dropped,
30.
of course, but it dropped to 33 and change, which was not even like a 10% move. And the market moved 3.5.
Yeah,
you didn't even have a 3-to-1 ratio
we had kind of a weird day on Friday, because Friday was a weird day. Yesterday was kind of weird. We were coming off the weekend, which will give you, especially with vol this high, coming off the weekend will juice that up a little bit. But you're right. It didn't quite catch up. It didn't keep up with what I was expecting.
Yep.
But what I was kind of looking at was the last time we were kind of, you know, rallying up to 1200, kind of where was volatility at that time.
Right.
And the VIX is lower than the last time we were touching 1195. Now, so that's what I'm saying. We're at this weird kind of crossroads where it's you don't know.
And, you know, I think probably you've seen it many times. So what you're really saying is all 1200s or any other level, not necessarily always created equal. It's also the environment. So
that's what we like to chat about on the show quite a bit, the contextual VIX,
that's
the thing that is not ever discussed.
1200 really. On the way down with people wondering what the next stop is.
That's a quick way not to get invited back on to CNBC, by the way.
Is different from 1200 on the way up.
You can blame me for that one if you want. I put that thought in your head.
No, you're right.
and so, you know, obviously you can't just drop in a void and say we're at 1200. So what's VIX? Because the momentum matters also.
Right. Well, think about this. 1200, 7 months ago.
That's right.
The VIX was at 22.
Absolutely. So you have to say it's the environment, and as you say, the context matters.
Chris, before we move off the broad vol, I mean, we haven't gotten into what you guys do over at Liberty yet, but are you watching these movements in the VIX and broad vol as well for your own portfolios there?
Yeah, certainly the realized vol, and to a smaller extent the VIX. We're trading 70 futures markets, and it's about 65% commodities. So I'm much more focused on, say, the volatility of corn or the gold volatility index.
GVX.
Okay. Exactly. So
those were also off the charts.
Yeah.
You know.
Yeah, those were. Those went parabolic in August and caused a lot of issues for option sellers. But we keep kind of a generalized view, big picture view on volatility through automated systems. But we're really looking. I mean, one of the things that I've really learned from attending here is ways that we can incorporate the VIX or changes in the VIX to alter our allocations to our underlying strategies based on what we believe are their return drivers.
Chris, I like you. I think you're on the right show already, because the first words out of your mouth were realized volatility. So you don't hear that very often.
And I mean, if you think the VIX can alter your trading strategy, looking at the Euro FX vol contract, that methodology applied to our market would be an exchange traded vol swap, which would be just an unbelievable product.
That would be interesting.
I mean, the dynamics between the implied volatility product, the realized volatility product, and the general market would be a trader's paradise.
Coming soon to a market near you.
Who was that saying that? Was that Coolio?
That was Mr.
Living in a trader's paradise?
Yes, that was his little known hit from 2003. Oh, the poor people clutching their ears across the hall. Chris, I do feel for you having to sit next to him. I'm sorry.
It's all right.
But
I chose my seat wisely.
Yes, you chose your seat very well.
I'm a newcomer. I fell into this.
Before we roll out of the vol review, we do like to talk about the broad spectrum of volatility products here that includes the Eurovol and the Eurovol contracts that are lighting up the tape these days over in the land of the CME. And Don, what prognostication do you have in store for us? We didn't give one last time, did we? We didn't give a pick. We took a pass.
I waffled a little bit. I said
we didn't buy our listeners any islands in the Bahamas last week.
Possibly a little lower, and I guess we did sell off a little. But there were a couple of interesting things. We had our 8th monthly expiration last Friday. So that was the 8th consecutive 1 month or one vol that traded and expired. And for the 8th consecutive time, we've talked about the volatility, the volatility of the product itself. So this was the 8th time where somewhere during the life of that 1 month product, we actually experienced a move of more than 30%. So we had from low to high of that contract a 34% move, which again just highlights the volatility of the product called volatility itself. We settled at about 1240. What was very interesting to me was something we've discussed numerous times on the show. With 2 days left out of 20 in the realized volatility period, so there were 18 days already logged into the formula. There were 2 trading days left. With 2 days left, we were trading at 1340, but the 18 days worth of realized volatility were in the low 12s. And so what that implied was we would have needed over 19% volatility over the last 2 days
another spread coming
to justify that price. Now, I'm never going to say never. I'm not going to sit here and say you can't have 19 volatility over 2 days. Of course you could. But again, I'm just going to say doesn't seem like that would have been the way to bet, okay? And so what happened, of course, is we didn't get anything like that. And we actually closed right around where the logged or partial volatility was in the low 12 handle, yet that didn't stop the contract from trading at 1340 with 2 days to go. So I didn't have a chance to say anything on the show, but that was a sale for sure.
Don, I can't wait.
That was $1 in 2 days. So.
I can't wait for this product to take off, so I can snatch you away from Volex and get you back into my trading firm.
And I got to tell you more. We have one market maker who's in and out, and you can't always say that it's going to be there every minute of the day. But he was making 20-up markets on both sides, and there was a 1340 bid. 420. I said, wow. Sold to you. That's $1. That's $1 in 2 days. So that was 20,000.
Mark,
okay?
we need
Did he make good on that?
We need
Don?
a drop
for
that.
Let me trade this thing.
You need an official Don Schlesinger sold to you drop.
Sold to you.
Now, of course, having said all this, I'll be humble enough to say on the other side, 16% annualized volatility is 1% a day, roughly. Square root of 252 is a little bit less than 16. If you move 2% in a single day, that's as if you had 32% volatility for that 1 day. The first trading day of the new Euro contract yesterday was this partial volatility of 32%. Because with $1.34 is the quote for Euro, 2% is 2.6 or 2.7 cents, and the euro's now at 136.5 or so. So we had 2.5 cents worth of movement yesterday, which of course doesn't make a settlement of 20 days, but we're off to,
off to the races.
32
nice
volatility
start.
For a single
That's
day.
a nice start.
So you got action right
What
away.
do you think, Don?
I'll go lower.
Sold to you.
Sold to you,
Sold
says Don.
to you.
Sold to you. Favorite 3 words.
But yes, so that kind of puts to bed all the claims we've been hearing that, they worry that the vol contracts aren't going to move, or towards the latter part of the contract's life with a couple of days left to go, they can't exhibit enough volatility to really move that much. And yet every month we see time and again, these things are just moving all over the place.
Hey, you get a day like yesterday. People have to understand, if there's 20 days to one of these realized volatility periods and 19 days are in the bag, and you've had like 1% volatility a day, back in the old day when there was such a thing as 16 volatility, and so you log 19 days worth of 1% squared, or 1 squared is 1 times 19. 19 days worth of contribution is 19, and then you get a day like yesterday. You get a day like yesterday where the market moved 3.5%. So 16 a day, that's 3.5, 48 and 8. That's like 56 volatility on an annualized basis. And now you square that at one single day's worth of volatility swamps the previous 19. You get greater contribution to the value of the contract, practically doubles in value just for the one single day of volatility at the end. So anyone who wants to tell you that this is like an Asian option where you're averaging the days and so you can't get any bang for your buck at the end, make yesterday the last day of an expiration, and you'll see what can happen with one single data point.
Hey, Mark, how much did Don's family get for them optioning A Beautiful Mind to
A little bit of a Russell Nash.
One of my favorite movies.
Russell Nash. He is a lookalike there, but of course.
I mean, I was just sitting there. He's like.
Listeners can't see the drawing in the ear and all the other things that Don is doing as we're talking, but it is quite the sight to behold here in the expo hall. And that is going to do it for the Vol Review. And now we're going to roll right into our Volatility Viewpoint segment.
Now it's time to discuss volatility and volatility trading strategies on Volatility Viewpoint.
A little island-themed music there to kind of good for what ails you here.
Found some lead-ins that Mark likes.
I know.
It's a long search, but he likes that transition. Of course, welcome to the Volatility Viewpoint. This is, of course, the portion of the show where Don and I sit down and parse some obscure topic from the world of volatility, and occasionally bring on a guest. And as I alluded to on the top of the show, we are joined by a guest today, diving into the hot seat on the live show. Chris, I'm impressed. That's a way to take it on the chin there, sir. But we are joined by Chris Strong. He is the Director of Research over at the Liberty Funds Group. Chris, welcome to the show yet again.
And holder of a really bad name, dude. That's awesome. Chris Strong.
Been a good name for a floor trader.
There are like 1,000 people in Hollywood that would pay for that name.
Yeah. There you go. You have a future in licensing your name.
Chris Strong here.
If this vol thing doesn't
Liberty
work out for
Funds. Chris Strong.
Well, Chris, why don't you tell our listeners a little bit about yourself and what you do, a little bit of your recent background in the derivative space and what you guys do over at Liberty Funds.
Well, I actually joined this space from atmospheric science. I got a doctorate in atmospheric science with a concentration on time series analysis. So
it's
about 15
segues perfectly into this. Yes.
15 years ago, I made the switch over to futures, the CTA industry, while I was working in France. But everything that we do, we've got a fund, about $45 million in it. It's multi-strategy. Totally, it's systematic. We're employing non-correlated strategies, and the intent is, to beat our benchmark of the Barclay Top 50 Index. So, what we do, it has elements of divergent trading, which includes trend following and short-term mean expansion, and then also convergent trading, such as option selling, out-of-the-money puts or calls on about 30 different futures markets. Again, a very systematic process that has near zero correlation to trend following. And then we also have some mean reversion just on futures in the short-term trading space. So a lot going on under the hood. It's a small shop, four of us. We've got an office here in Chicago, does trading and research, and then back office and marketing in Dallas. So I'm coming at it from kind of that, scientific background. I had no background in finance before I started in this space, so I kind of learned as I went along.
Probably better off.
Yeah, and a lot of places like that. If you don't come in with a certain like a Wall Street background or something like that, so
no biases.
Yep.
So I'd imagine since you guys are located in West Texas, a lot of the early portfolio work you guys did was concerned around hedging oil and oil risk.
Yeah, actually, a lot of the investors in the fund are high net worth individuals from Texas, and they're already long the dollar, they're long oil, so they're looking for diversification that way, and that's been our biggest audience, along with some family offices and some fund of funds. But it's been it's been a slow growth process. We made money in 2008, and then proceeded to have a bunch of our assets ripped away because these people had liquidity concerns elsewhere that they needed to cover. So
kind of like what we saw in gold last month.
Yeah.
Right.
Yeah.
Chris, can you tell us a little bit about the short strangle selling program and just some of your parameters and how you set things up, what you look for going in?
Now I know why you wanted to have him on the show, Don. Premium selling. Here we go.
About that. I never knew.
And before you answer that question, when you're in your financial laboratory, do they make you wear the long white jacket?
Yes. Well, just to frame this, we started with just a trend following strategy some years ago, and that's, it's easy to design a trend following strategy that has 0.9 correlation to the major CTA indexes. That strategy is it's a dreadful strategy to trade because you're only right about 35% of the time, but when you are right, you have a 2.7 or 2.8 to 1 win-loss ratio. So that's what makes it worth it. You accrue a series of small losses in the hopes that you catch an 2008 type event. Ride everything up, ride everything down, assuming that you do go long and short all markets. So that was the first of our strategies. It's frustrating. We look at that strategy versus the VIX, and what you saw is 2003 through 2007, the VIX index underwent a gradual decline, and those were some very difficult years for the managed futures industry, most of whom, I think there's about $250 billion in managed futures, and most of that is involved with trend following strategies. So those were some pretty tough years because they're cranking out negative returns or small single-digit returns. Event like 2008 comes along and knock it out of the ballpark. Some of the more aggressive trend followers made 100+%. And then the collapse in volatility in 2009 was made one of the worst years in managed futures industry. But to get to your point on the option selling, that was another idea that came around where we said, okay, trend following's wrong 2/3 of the time. We can harvest some information from that model. We can fade the trend following. So if we have a long signal from from a suboptimal trend following model, we get a long signal, we're going to sell a call. A short signal, we're going to sell a put, and maybe go two calls, 2 puts. So we're limiting the risk per market. Tested that on a number of markets, and what we found is that if we establish some very strict risk per trade and profit objectives at the start of the trade, we had an inherent source of return, and it's done fairly well. We're taking into account the 21-day average true range on these markets, so it's giving you a sense rather than close to close volatility. It's taking into account that high-low range as well. So we're then spacing ourselves vertically away from the price based on a multiple of the ATR, and then horizontally in time, we're looking to kind of sit ourselves on just as the time decay, as the theta really kicks in, say in that 30 to 40 day window.
That was my question for you too, because I know you mentioned here in your wealth protection strategy that it has two components. One, you mentioned, of course, that trend following is wrong primarily, and then also that the time decay obviously increases exponentially as you get towards expiration. So my question then is, you said 40 days. Are you starting to migrate even shorter term, maybe towards the weeklies, or you found that to be the optimal period of?
For what we're doing, we like the like that 30 to 50 day time frame. We do an assessment. If we're looking to sell some S&P calls, we'll look at October, November, December contracts. We'll make an assessment of, okay, if we hit our profit objective on that trade, how will it impact the portfolio? And if that's, say, less than 15 basis points, it's not worth it. So we'll move it out to the next month and take a little more time on the trade.
So you find that's kind of the nexus of enough premium to be worth your time.
Yes.
Yeah.
Yeah.
At the same point, you're getting at the cusp of the vol
Is
decay.
this? I'd be interested to hear. Are you selling like this wide, far out type of premium, or are you more getting in toward at the money, or at least within kind of the realm of feasibility, kind of premium areas?
Yeah, it's. I think we're playing it in quite a bit tighter than a number of option sellers. I know our leverage. If we look at our margin to equity on that options program, it's running only around 16%, whereas others that I've seen are running higher than 40 or 50, 60%. So what we're trying to avoid in option selling is the catastrophic game-ending loss where you make money, lose 60% in the space of a month, as some option sellers did in August, or some did in, as a game-ending event in third quarter, fourth quarter of 2008.
I see you shivering over there.
And you've actually figured out a way to do that, huh?
Well, there are ways that we've mitigated the risk. We certainly
just stay out of Netflix, and that's a good start.
Yeah.
Well, I think there's a lot of misconceptions about decay, especially within the general public. Everybody sees that beautiful-looking time decay chart that everybody likes to roll out, but that doesn't apply to every option. That applies to at the money. That's me banging. That's me.
The listeners
banging.
are clutching your earphones right now. That's Mark Sebastian.
That's
banging
at the
table.
money. Every option has kind of its own path of decay relative to how close it or far away it is from the money. And if you can kind of structure as that option is moving from something that a lot of people see as feasible toward not feasible, you can really kind of capture that kind of sleigh of decay.
Well,
if you will.
This is one of the principles in selling time premium, and it's something that you've just mentioned. When I was on the trading desk at Morgan Stanley, we did almost exactly the same thing that Chris just mentioned. We sold 30 to 50-day strangles, which is out-of-the-money options. One of the reasons that I like doing that as opposed to selling straddles was exactly what Mark just mentioned. At-the-money options decay according to a square root function, which means slowly at the beginning and more quickly at the end. So whatever the time period is, when you've gone only halfway through that time period, you haven't lost half of the premium in the options. You've lost the square root of a half, or about 71%. You've retained. You've only lost about 29%. So you're actually still in the ball game if you're a buyer. You're not getting eaten alive by the premium decay. It takes all the way until there's only a quarter of the time left in the life of the at-the-money option. And with a quarter of the time left, that's 0.25, square root is a half. So the options lose half of their value in the first 3 quarters of the life, and then the other half in the last quarter. So in 1/3 the amount of time. Now, when you sell out-of-the-money options, it's very different because they decay almost linearly, if not a little bit faster at the beginning, and then there's nothing left at the end. Because when you sell an out-of-the-money option, you get a certain amount of time for something to happen, and then if it doesn't, the option gives up and says, I'm going to expire worthless, so why should I have any premium left? So it's like a ski slope, and it basically taking out a good deal of the premium right up front as long as nothing happens.
And Don, I think to that point, when we enter these trades, we have a utility function in place. So we've had trades on in nat gas. We've sold puts or calls. Inventory number comes out. Nat gas moves some psychotic amount, like 8.5%, and so the options draw down 50-60% from where we sold them first thing in the morning. We'll close that out that day. So we're not going to we take that approach where we're not letting these options hang out for the entire life or until expiration.
And it sounds like you're actually getting some juice for your risk, unlike So a lot of these strategies that you hear about blowing up are getting, teeny amounts of premium.
Oh yeah,
and
the teeny
the
put
old,
sellers,
the old 87, the old 87 sale, as they like to call it.
Yep.
So I mean, that's the other part. Basically, you have a profit objective in mind, which is what you stated. And if things are going your way and the underlying is reasonably stable and you're getting the decay that you want, you don't stick around for the last nickel or what have you.
No.
You're happy to take out a certain percentage of what you sold and then move on to the next one.
Yeah, and on the defensive mechanism, once the option is sold, we will have resting orders in the futures markets to make ourselves delta. So say a market moves up to our strike price, now we're at the money. Say we're 0.5 delta, we'll sell or buy futures to offset that in such a way that we make ourselves delta neutral, and then we'll decide whether to unwind the futures and let the options continue, or to just unwind both the options and futures on that day.
Chris, I got a question for you. Does you're talking about the fact that you really don't have a lot of correlation among all the different strategies that you're trading. Has that allowed you to take advantage of kind of supply side skew and some of the supply and demand factors of volatility that affect option prices? Is that something that is a hindrance, or is that something that you can use to your advantage on kind of where you sell along the curve in either direction?
Well, we don't. I don't think we've really looked at that yet. We're agnostic to that in the sense that we do have a directional bias when we sell these options, because we're saying, we're not selling both a put and a call. We're saying, okay, directional model, we don't trust you with your long signals, so we're going to sell consistently.
I love that you're just fading models. That's
you're fading your own model.
Oh yeah, a multiple of volatility away, in a consistent way. And lately, we've been getting paid better. Sometimes, you'll get paid better either on the put or the call side, but the premiums have risen with the volatilities, but we're still keeping that, we're measuring that recent volatility, so we're always spacing ourselves that way. So, this morning we sold some 1260 E-mini S&P calls, so just to give you an idea of how far away we're playing. And others may sell the 1290s or the 1300s, but for 10 of our options, we find that a lot of others are selling maybe 50 or 100. So, like I said, that we're keeping a conservative approach in terms of margin equity, and then also always having a game plan from the moment it's put in. If we get hit, what do we do? Well, we buy or sell futures, and we limit our risk that way. So the intent was not to have that game-ending month like a number of option sellers have had.
So there are a lot of strategies that either adjust to delta, or they consistently kind of sell the same percent out of the money.
Yep.
You take kind of a cross between the two and kind of say, well, we can get kind of this premium for kind of this far away and build. So really, there aren't a lot of people taking that kind of holistic approach to premium selling.
Holistic, I like that.
Holistic.
It's the way I always trade.
That's the way. It's the way everybody should trade, but it's the way nobody trades is the problem.
Yeah.
Now, Chris, we talked about you maintain delta neutral positions a lot. That's one way a lot of people can use to spec on quote unquote pure vol. You trade a lot of commodities. Do you also trade in some of these vol products as a way to manage vol risk? Like, are you trading a lot of, let's say, the GVZ for gold or anything along those lines?
No, but we are looking into it. One of our research projects right now has been to say, just to be upfront, the option selling, I think in general, has been just a treacherous strategy for the last. It depends on what space you're in, but if you're a diversified option seller, where you're trading commodities and S&P and T-notes, it's been a challenging environment because of the almost every other day market dislocation we have based on Greece or the Japanese earthquake, tsunami, nuclear meltdown. I mean, there are things that I hadn't seen in a back test. You could say we put a lot of faith in our back test, but the last several months have been very challenging. We've come under a lot of heat in that strategy. Strike prices are frequently threatened within hours or days after the calls or puts have been written. And so we're looking at ways that we can say, okay, if we take the VIX and we look, one of the things I did is I broke out directional, the trend following strategies, how do they perform versus the VIX year over year? And of course, one of the best years for trend following was 08. One of the worst years for option selling was 08. So we're trying to look at ways in which we can incorporate the absolute level of the VIX or the change in the VIX over N number of days in order to play defense with our option selling strategy. And we're also looking at the gold, the gold VIX, the oil VIX, the euro currency VIX as kind of external inputs. I mean, we're a very price-driven shop. So if we're looking at, other inputs that can kind of make us better at what it is we do, we will welcome that. We're also looking at that VIX futures as a way to hedge out, the option strategy where we may buy or sell those futures.
Oh, you have fun with that one.
Yeah.
The VIX futures are super easy to handle. They make total sense. They trade completely logically.
It's a good thing we're on the other side of the hall from the Seaboat.
And they're the futures trader's dream because everything makes total sense with how they move.
Can you see sarcasm over the radio?
It's kind of hard.
Yeah, no, I by that mean that's the exact opposite.
But here's an interesting point, both for Mark and Chris, and something that Chris just mentioned that I was very acutely aware of when I was on a trading desk doing the same type of thing. People often talk about, it's great to sell high levels of volatility, high implied volatility. And, it's sort of like the reverse of you get what you pay for. You really don't want an environment when you embark on this kind of a program where every day the market dislocates. It's just the worst feeling in the world. So what you need to understand is you can sell 30 and 40 volatility. If the market's going to move 3.5% a day and blow through your strike prices on the first day, it's an awful environment for that. I had markets where there was single-digit realized volatility, implieds at 10 and 12, and I was happy as a clam selling premium because the market never went anywhere. And, you just sell these things and they go to zero, and if you sit and watch like paint drying, I don't know what I would do in today's environment. It would surely be a hell of a lot more challenging than some of the environments. You'd be up a little later,
I think, and taking a few less bathroom breaks during the day.
But it just points out that it's not just a question of, high levels of vol or low. You care about the actual movement. And yesterday was a terrific point to be made there. If you had 3.5% movement yesterday, everybody knows, we were talking about it before, VIX dropped yesterday. We all saw that. Market goes up, VIX goes down. Okay, VIX dropped from 36 to 33. Well, guess what? If you owned a straddle, you made a fortune yesterday.
Made a killing.
Okay? So there's volatility and there's volatility. There's implied and there's realized. On a day like yesterday, what you want if you're trading volatility is you want the realized kind that we're trying to bring to the marketplace. When the market moves 3.5% and you're a volatility trader, damn it, you want to make money on a day like that, not lose money.
And that's why when I'm looking at the VIX, I think it's really important to pay attention to strike volatility as much as the VIX overall itself, because strike to strike volatility, it gives you far more insight into how volatility is moving. I got in a big argument with somebody that was explaining to me, well, if the VIX is down, that means vol's down. I explained to him, I said, no, vol is down if you're short Vega and you make money. Otherwise, it's not. All right, and that actually, and that kind of shut him up, actually, like that. It was pretty fast.
We talk about frame of reference a lot on this show, too, and the frame of reference we have for volatility. I mean, look at today as a perfect example, too, of the different types. We talk about close-to-close versus, first-time exit or the barrier methods. And a day like today where I think the S&P was literally unched, and I think it was about half of a handle today, yet it had a relatively sizable intraday range. And so, just looking at the frame of reference of how you view this volatility and how you model it, you could be you're trading intraday, you did fairly well. Whereas if you just looked at it close to close, it was a relatively non-event on a day like today.
And of course, that's always the argument when people say, you buy a straddle, you sell a straddle. Both two people do the opposite side of the trade, and a week or two goes by, and they both make money. You say, well, how does that happen? Well, the market started out at 100, then it went to 120, then it went to 80, then it closed at 100. And if somebody's got the stomach to just sit there and watch that, 2 weeks later, you're unchanged. And if you sold the options, you made a lot of money. Meanwhile, the intraday trader the pure volatility trader is trading every one of these moves, both up and down. He's getting delta neutral intraday. He's taking some money off the table. He's ringing the cash register 4 or 5 times. When the 2 weeks are over, he's made money also, and they both started with the same trade and opposite sides of the trade.
Well, Chris, since you're dealing with a lot of these, these large funds and other clients and structuring products for these guys, are you starting to see more cognizance in that community of these types of risk, vol risk? Are they starting to come to you saying, how are you managing our vol risk of this portfolio? Is that something they're even aware of yet, or is this kind of something you're bringing to them as you think in this environment with all of the education and interest we've seen in volatility, and obviously doing a show like this geared specifically around volatility, is that something that's reaching that audience yet?
A very select few. I mean, many of our clients don't really know what's under the hood. All they care about is at the end of the day, are we hedging out their long dollar exposure, their long oil and so forth. But they have come to us. Some of the more sophisticated ones who are aware of what's going on in the volatility space are saying, what are you doing to mitigate the risk in the option selling strategy? And one of the studies that I did recently was, like I said, we're agnostic as to the level of the VIX, and so because we take that into account when we space ourselves away from the underlying. But one of the problems that the option selling has had, certainly in the commodity space, if you look, say you're spacing yourself vertically a multiple of ATR, and say the ATR is 21 days. Okay, now if you look at a shorter term ATR, say a 5-day, you say how many times does that 5-day ATR exceed the 21-day ATR by some factor? Let's call it 1.25. So if that's happening, that means that your option position is coming under a lot of heat, your short option position. You look at one of the best years for option selling, 2009. I did this study on corn. I looked at that 5-day versus 21-day ATR. Found that the 5-day ATR exceeded the 21-day ATR by a factor of 1.25 2 times in the whole year. Wow. Since Q4 of 2010 through a couple days ago, it's happened 22 times. So this erratic nature of the shorter-term volatility is really what's raising havoc with us, and that's what we've had to explain to our clients. At the same time, that's also caused some problems for the trend following with the sharp reversals and so forth. So even though we have seen recently higher levels of VIX in 2011, the latter half of 2011, directional strategies are also struggling. So it's been a very difficult year in general for managers.
Have you responded to that by really widening out your strike selection now and giving yourself a lot more room, pretty much?
Yeah. And also one of the other things that we found in our research was, if you look at, why most option writers trade the S&P? Because there are 500 mitigating units under the hood that are all fighting each other. It's an index. So that jumpiness, that erratic short-term volatility versus a medium-term volatility is not as bad in an index as it is in, say, the Japanese yen or natural gas. So one of the steps that we took was to say, okay, we don't really want to be in the business of trading corn or natural gas outright. Let's throw those guys in an index and make them fight each other. So we created our own proprietary currency index and commodity index, and that has because you look for a very low correlated pool of instruments so that they're fighting each other.
Have you tried selling cotton yet?
Yeah, we have.
That'll be a fun.
Yeah,
one.
Yep.
You like
but
Bail?
It's
Bail
only
your unit, your instrument of choice?
What's that?
Bail, the cotton ETF. We joke about that a lot in one of our other shows.
And one of the reasons we tried to stay away from selling straddles and strangles on individual stock names as opposed to the indices is we always said an index can't be taken over.
Right,
so
or an index can't gap.
Eliminate certain kind of risk, certainly not all risk, but certain kinds of risk.
What fun is that, Don? But okay, with that...
sorry.
Go ahead, Mark.
Well, no, I was just going to say, I think if you really boil down your research, I think what you would find is that option selling works in almost every occurrence except when volatility goes from low to high. If you look across the entire stratosphere of when option sellers have blown up, it really hasn't been when vol's really, really high. It's not when vol's really low. It's that transition when the VIX goes from 18 to 40 that everybody loses their shirt.
Yeah.
Mine, of course, was.
I noticed you had to change shirts here. Was your shirt blown off since the last
France. Yeah, my Barney France shirt.
All right, and that is going to do it for the Volatility Viewpoint. And now we're going to roll right into our Crystal Ball segment.
And now we take a look at the crystal ball.
Nice and soothing.
That's awesome. It's got kind of like a...
It's a trance mode one.
You know what? It reminds me of. It sounds like it could be out of Transformers actually in many ways.
Well, I wasn't thinking.
We're not going to go Transformers, but that could definitely
for the other
be
show, sir.
The backdrop of Optimus Prime transforming. Just saying.
All right, and welcome to the Crystal Ball segment. This is, of course, a portion of the show where we prognosticate wildly. I have to hold Don back from making extremely outlandish predictions.
Crazy Don.
I think we're going to mix it up a little bit this week, Don. I think we're going to start off with you this week. Let you take the crystal ball reins and run. I know we talked a little bit earlier in the Vol Review segment about how you saw some nice discrepancies there in between the implied and the realized vol coming into these names.
Of course, it's a difficult period, at least talking about the euro and knowing what's
not too much happening in the Eurozone right now that could really impact that.
Days and weeks ahead, but
nonetheless, go out on a limb, sir. Let's get some islands in the Bahamas for our listeners again this week.
I looked at some of the charts before I came over, especially of longer dated. The average volatility of the euro over the last year has been very low 12s, and last 3 months, like 13 or 14. Anytime you start off with a bang the way we've done here, it not only scares people into thinking, it could be a whole lot higher, but it actually logs a few data points into the next month's contract that start you out rather high. So get some high numbers and a chance to possibly trade that environment. So I'll go out on a little bit of a limb and say next week when we take a look at that front month one vol, the November euro, probably be trading somewhat lower than where it settled last night.
Whoa, you're saying we're not going to be at
huge
56% next week?
Huge limb there.
Oh, Don.
And of course, Chris, you're the newcomer to the panel here today, but this is the portion of the show where, like I said, we prognosticate wildly. So if you'd like to make any sort of long-term or short-term predictions here on what we're going to see in your crystal ball it could be commodity vol, could be broad equity vol, whatever floats your boat, sir. Whatever you want to dig the hole with, by all means.
Well, as a systematic trader, I don't take any real, discretionary views on the markets.
What fun is that?
I know it's rather boring, but one metric that we do look at is the option strategy, the rolling sharp of our individual strategies, and worst drawdowns, and it feels like the option strategy has started to turn a corner the last couple of weeks, and it's near worst drawdown. So I'm kind of looking for vol to kind of drop, and I think this every other day deal with Europe can only sustain itself so long, and I think it'll work itself out. So but that's just my opinion, and I don't really have any strong macroeconomic views. We just follow these systems that we've tested.
Trust me, Chris, you don't need a strong macroeconomic view. You don't need a strong anything to pull something out of your butt, which is what I'm here for.
This is what Mr. Sebastian is about to do. Mr. Sebastian, we heard your prognostications on the last show, but repeat them here for our listeners. Correct me if I'm wrong, you think vol is going to stay pinned precisely at 32 for the next 2 years.
I believe I call this situation the 2 a.m. at the bar situation.
Yes.
All right? You don't have to go home, but you can't stay here. All right, so if you look at patterns in the VIX, Chris, stop me if you disagree with me. At every time we've gotten right to where we are, we've popped higher very quickly. All right, or this is going to be that final nail in the coffin, and we're going to really take a dive. I know we don't talk a lot about options here, but on the last show I mentioned that I think. And I know, Don, I'm about to commit sin number
He's
one.
He's going to go long premium,
I'm about
Don.
to commit
He
sin
might do
number
that.
one. So
cover your ears.
Cover your ears, Don. The 35 straddle for $4 in the VIX futures with the VIX already at 32.80 is a steal of a play. The futures are trading around 34.5. You'll recall. Is a steal of a straddle, and I think it's really hard not to buy. November looks kind of cheap to me too, and it has more to do with the fact that VIX option premium is cheap.
Yeah.
Right. And I would certainly say that if that's your view of the market, then that's the right thing to do. Some people who are chartists and look at congestion points where you're at a point where you say, I don't know whether we're going up or down, but I just know we're not going to be here in a month or so, or 2 weeks, or whatever the case may be.
You just call that 2 a.m. at the bar.
Right. So if you're at 32 and you're convinced that you're 8 points higher or lower, then that's the right thing to do, especially if others don't agree, as reflected by the volatility options, of VIX options that are, priced correctly or even relatively cheap in this environment. So you go out and you do something like that because you think everything is conspiring to make that the right thing to do. Doesn't mean you still might not lose money, but, just the fact of hanging around for 32 for how much longer?
Right. And the nice thing about a strategy like that is that, and this is actually people that learn the VIX options, the way the futures trade at kind of that contango or backwardation to the cash, and yet it settles to cash in a situation like this where we're going to, where you're buying a straddle that already has a couple bucks embedded into it. Kind of a nice little play for me, and that's kind of the way I'm looking at things. In terms of realized volatility, I'm on your side in terms of I'm a seller.
I don't know, Mark. We have two.
That's an official sound effect for the
yes,
I'm a seller.
We'll add that to the soundboard. I don't know.
We should just put that under. Whenever Don says sold to you, it'll be sold to you.
They can keep VIX at 32 for the rest of your natural life, but 32 volatility for real volatility, for market movement, is 2% every day for
I know,
as long
it's
as
impossible.
you want to do it. And have we had 2% moves, and a lot of them lately? We sure have. Is this just going to go on for months and months or a year? Well, you're entitled to your opinion, but my answer is no. So if you're trading real volatility, if you're not worrying about whether implieds are going to move one way or the other intraday or tomorrow or the next day, but you're just position trading and you're trading straddles or whatever and trying to actually capture the actual volatility of the market, I'll fade 2% moves every day for a month, almost any time.
Where would we be if we couldn't rely on mean reversion over the long term? No. I mean, we wouldn't have a business model.
So it's just kind of
ask
interesting.
Long-term capital, that same same
we're
question.
in an environment right now where everybody's just accepting that 32 is the norm, that we've moved to a different level, that nobody remembers when normal market volatility was 16, which was half of this. That's a big number. You could be a little bit more volatile.
I was
and
on
have 20 as the norm, or 24.
I remember the VIX fell below 10.
Yeah, 32 and call that the norm. I think people may have somewhat short memory, so we'll see.
I don't know, Sebastian.
We'll
I think you're
we got
outnumbered.
to keep meeting like this. We'll see what happens in a while.
Listen, all I'm saying is that I agree with him, but this is just my way of playing it.
I think you're outnumbered on the panel with degenerate premium sellers.
There is no way S&P volatility can keep that up all day. They just can't.
Between Don and Chris, I think they're going to
I
fall heavier on the other end of the spectrum.
The good news is I'm used to being the dumbest at the table. So
there we go.
That's worked out well for that's it's something I've held close to my chest my whole life, and it works out really well.
I'm glad that it's worked out so well for you, sir. But with that lovely sentiment in mind, I think it's going to close out this episode of Volatility Views. I want to thank Don Don for joining me here from the Volatility Exchange, as well as Chris from Liberty Funds Group, and, of course, Mr. Sebastian from OptionPit.com. Really quick, Don, we have like a minute. Anything else? Anything coming up at volex.us that's really interesting you want to let our listeners know about here?
Nothing too exciting, nothing new, but, we do keep on trying to enhance the website. We keep inviting people to take a look. There's a wealth of information there. Volex.us. If you're interested in volatility, you'll be happy to take a look.
I mean, it's the resource. If you want to really just learn volatility, what is it? What does it represent? There's not a better free resource, not at any of the options exchanges, not at any of the futures exchanges, on realized volatility. What is it? What does it do? What does it mean? The Volex.us is the resource for it on the internet.
Just for the vol cones alone, I think it deserves a special mention.
They have the prettiest cones in the world.
If you're a vol cones aficionado, Volex is the place to go. But I want to thank everyone here for downloading and streaming and subscribing to the show and making Volatility Views such a success. And we'll see you next week right here on Volatility Views.
Thank you for listening to Volatility Views. Join us next week as we keep our listeners on the cutting edge of finance and risk management with lively topics relating to volatility. Volatility Views is brought to you by the Volatility Exchange. If you'd like to learn more about vol contracts, please visit www.volex.us. If you'd like to submit a question for the hosts, then surf over to www.theoptionsinsider.com/forum and post your question in the Volatility Views forum. Questions can also be submitted via email at questions@theoptionsinsider.com or via Twitter at twitter.com/options and twitter.com/volex_info. Facebook users can submit their feedback via the Options Insider and Volatility Exchange Facebook pages. Voicemails are also welcome at 312-544-9356. Thanks again for listening, and we'll see you next time on Volatility Views. The views expressed on this program are not intended as investment advice and do not constitute an offer to sell or a solicitation of an offer to buy any securities or other financial instruments and may not be relied upon in connection with the purchase or sale of any security or other financial instrument. The opinions presented on this program represent those of the speakers and do not reflect the views of either the Options Insider Incorporated or the Volex Group Corporation.
Regardless of how active you are as a trader or investor, a firm understanding of the inner workings of market volatility is crucial. You are invited to join pro options trader Mark Sebastian and pro futures trader Jeff Quinto for this one-of-a-kind live event on October 21st at the Chicago Mercantile Exchange headquarters. After Jeff discusses how volatility can play into the hand of a futures trader and Mark covers how to use volatility to trade options on futures, together they'll present unique combination strategies using futures and options in tandem. This interactive event will benefit every level of investor, from the novice futures investor to the most active futures and options day trader. Don't miss this rare chance to see two industry experts in one spot. Please go to pricegroup.com to reserve your tickets today. The cost of this all-day event is $895 before October 1st, with $500 off for Price Group customers and new accounts. Again, please go to pricegroup.com to reserve your tickets today.
The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.